Okay, everybody, John Blank here, talking through the Zacks four sector strong review. And the four sectors that we're going to talk about today, August 26th, is autos, tires, and trucks. That'll include Tesla, General Motors, things like Stellantis. Basic materials, Southern Copper will be in there. Lele will be in there, the iron ore producer. And a fair number of other companies that you will know, such as Albemarle, the lithium provider. Construction, this will be unique to this group of portfolios because it will actually run successfully on the Zacks Rank and not market cap. The other three will be driven by market cap, interestingly enough. So keep in mind that this is a structure that we're going to put in place all four times through. The first part will be market cap. The second part will be the Zacks Rank. The third part will be number of analysts. And the fourth part will be the criteria for all three. This should give you the background that you need to think this through. So here's my disclosures. These are my views, John Blank, PhD, and they are not necessarily the views of Zacks Investment Research. Of course, past performance is not a guarantee of future results. We're just talking about history, and in this case, it is the history of the last 8 years. So let's get going. Okay, the list of companies by market cap. We're going to list these first by initial 24 recommendations. And you can see here, May 20th and June the 3rd and June the 28th and July the 26th was when we did videos on these different sectors. That may be helpful for you to go back to those videos and see the given industry stories in much greater detail. Today, we're just doing 6 stocks in each of these industries, and we're doing the market caps on August the 22nd, as you can see in this video structure here. Here's August 22nd. There it is again. So we're going to go first through trucks, autos, tires, and trucks. Then we'll go basic materials. We'll actually do construction in third, and then industrial products fourth. That will be our strategy today. Always come back to this slide. This is the most helpful slide for your efforts. Okay, autos, tires, and trucks, portfolio return measures, and asset allocation. This is the big stuff here for portfolio construction and how to pick, the right weighting of stocks. So let's get going. All right, first off, we got average percent in a month. Then we've got cumulative terms over the 8 years, and then compound annual growth returns in percentage time. So, for example, the average monthly holding of Tesla over the last year gets you 4.5%, PACCAR 1.5%, GM 1%. And of course, compound annual growth returns really show the matter. 40% annual returns for Tesla, PACCAR was 16, GM was only 7. Very, very low. Fox Factory Hill, you probably don't know, they're down in Atlanta. They make shock absorbers, fancy shock absorbers. So cumulative returns, 1382 for Tesla, really sets the standard. The next one down would be BYD with 383. Of course, the electric vehicles are stacking up in this business, and they're driving everything forward. Now, down here in the correlation area, notice that Tesla does not correlate well with BYD or Stellantis. It correlates a little better with Ford and GM, of course, because it's American, but not very much. That's really kind of critical to this story. Then down here, we've got the portfolio return metrics. And of course, if you overweight Tesla, 35% weighting, you're going to get a 717% return over those 8 years. And if you don't, you get to 526. So, of course, picking stocks right is important. And of course, if you held Tesla, you got it right. That is, by the way, looking back, not looking forward. Okay. Portfolio return metrics, we just want to show you that using the 1 percentage change in forward annual estimates for this particular industry does not improve things. Look at the cumulative returns. Cummins comes to play now. CMI is a 200% return over 8 years. Not that great. ALV, Magna, 44. BLBD, Ford, 27% return over 8 years. It's just nothing. It's 3% annualized. Very, very low. 75% returns for Toyota, largest automaker in the world, 7% annually. Not great. And of course, down here in the correlation matrices, you do see stronger connections to these different groups. The parts makers and the automakers that are not electric do correlate well, but of course, they don't make any money. And you can see that down there in the cumulative returns, 152, 210, 138, just not that strong. Okay, now part 3, we've got maximum number of analysts. Get a different number of companies here. I should say different names of companies here. BMXF, GPC, LKQ, Stellantis, and Magna. Of course, all of these much more strongly correlated here and not producing the returns that we would like to see. So again, if we look through this as a four-part sequence, we get back to realizing, once again, Tesla and BYD really drove everything. We put them back into play here. And of course, we get back to 600%, 700% annual returns. So the stock picking in this business was really important, and electric vehicles mattered in the last 8 years. I'm not sure if it will in the future, but it did for the past. All right, basic materials. Let's go through this particular industry. All right, we've got new stocks, Lind Chemicals. Air Products and Chemicals is a French company, AIQUY, BHP, which BHP is a Billiton, that's iron ore in Australia, SCCO, Southern Copper, that of course is a copper play, and Vale and Nucor being iron ore and steel. So, cumulative returns, Southern Copper was your big play, of course, because that was the electric story here, and the power grid story, and the battery story, and of course that was strong. And now if we see the correlation matrices down here, they're a little lower, but still quite good. Air Products and Chemicals, AIQUY, and Lind are very highly correlated, so keep that in mind. If you want to swap stocks in and out and not have a lot of difference in the story here, you want to have that correlation be fairly high. Those are good swap stocks. So down here in cumulative returns, you can see that we didn't get much more than 340 to 380. We got a little benefit out of a stronger swap, mainly because there's just not as many differences in stocks this time around. All right, so forward 1 month percentage change in estimates. The Zacks Rank for basic materials dumps a ton of poor stocks on us. Cumulative returns in this, you can see minus 74, minus 44, minus 57, minus 1.8. We're just not getting good stocks in here. So keep that in mind. It's just not doing it. So, why? Because I think we have a lot of negative earning companies that get upgraded but stayed negative in profitability, and that wasn't attractive from a final stock market perspective. So the cumulative returns down here are very poor, 57, 149, 97, not great. All right, max portfolio return number 3, the maximum number of analysts. Albemarle's in here now, ECL's in here, Tech is in here, Vale comes back, and X is found here. So cumulative returns are not great for anyone. Tech is the best, 239, and that's a 16.5% annualized return. Down here in correlation matrices, there's in the 2s and 3s for Albemarle. Again, this is not quite as strong as some of the earlier ones when you saw, like, for example, Toyota and Magna, part maker and an auto supplier. That would be, or automaker would be very strong. That's not as strong here. And again, lower overall returns, 216, 240, and 228. Not as great as we'd like. All right. Here we've got the all three together criteria. And as you can see, it's really driven back up to Lind and Air Products and Chemicals, which we can go back to all the way to number 1. That clearly was the best way to go. So when you're in these big industrial areas, market cap for autos, tires, and trucks and basic materials is really important. Tells you a lot about these businesses, and that is something we should keep in mind. Construction will be different, and we are going to talk about that next. Construction sector has obviously a growth stock perspective now because of the amount of infrastructure spending going on. That is the difference here, and we'll show you that. So number 1, Sherwin-Williams, CRH, HCMLY, URI, which is United Rentals, of course, 870% returns over 8 years. Extremely strong. You made 9 times your money. So almost a 10-bagger. DHI, Danaher, VCISY. So these are the best stocks. And of course, go back to that first page and look through it. But the compound annual growth here, super strong. URI, 32% annualized, almost as strong as Tesla. DHI, actually quite good, 25% annual return. So you can pick stocks here, do quite significantly better than the S&P 500. Down here in correlations, 0.6s and 7s for Sherwin-Williams. So this is a very tight industry, very tightly organized industry. You can swap stocks out in this particular, and you get decent returns. Compound annual growth on an equal weight or overweight is still going to be in the 21 to 22% range annually. So you really did well with this business over the last few years. Now, what's interesting here, if you get into this, largest percentage change in forward estimates, we get new names, Aspen Fix, particularly Fix, 1,057. That's a 10 bagger over the last 8 years. Incredible stock. KBH, 500. MCore, 597, 600. And ARCAY, 390. So there was incredible stocks that were picked up in just construction. You can see down here that the correlations are not high. They really were just in niche businesses that we found through this method, and we found high returns over here. You can see 761% if you overweighted Fix because of that 1,000%. That was much stronger than even Tesla, folks, even Tesla. So incredible stock, incredible story. On to the next one, maximum number of analysts. Here we got LII, Trex, you might know that one, Masco, Sherwin-Williams makes a repeat. Danaher, of course, is back, MTH. And of course, down here in the correlations, very strong now. As remember, back a page ago, correlations were not very strong down here. Now they are very strong down here. So we're seeing that, the Zacks Rank really found you niche businesses in the construction space if you wanted to find them. Over here, cumulative returns are still good. These are 25 and 23% annual returns. And if you overweighted Trex and some of the better names, you got better returns. That's no surprise to anybody. Here's our 4-part sequence, which again is just telling you what I've told you. If we go quickly back through them, 750 is our best here. This is the 520. There's 760, and there's 360. So really, what you wanted to do is here, that was the overweight with Fix and using the forward estimates for just construction now. All right, that gives me to my 4th sector, industrial products. And we can go through this and show you what's happening. Number 1, market cap, Ball, PKG, SIEGY, Cintas, CSBG, SY, and ETN. They're all really well-known names. Cintas probably the best, 676. Really did strongly. And of course, the correlations not as strong, but still good in the 3s and 4s down here. Of course, overweighting some stocks that do quite well. Cintas, in this case, will be in portfolio 2. And of course, over here, portfolio 2 works best at 420% with 23% annualized returns, which is quite good, folks. Keep that in mind. I mean, anytime you get a 33% annual return, you've done quite well. So these industries were, picking these top stocks in these industries did work. It did work well. All right, so forward estimate revisions for this group. Not as strong a play down here. We're in the 150s and 130s. We're pulling up some names that don't do well. AZZ, ENS, things like ASAZY. These names just didn't help out in using the Zacks Rank structure this time around. Not to be surprised for these types of heavy scale businesses where market cap will play a much more important role. Okay, down here we can see maximum number of analysts, and we get Cintas is again carrying all the weight. And if you get Cintas into the business and overweight it in the 3rd portfolio, you get 340% returns. But if you don't, you get 10% annual returns and 125% over the 8 years because it's just simply not delivering for you. So keep that in mind. Now, back to portfolio return metrics. A top, again, not showing us much. We're in the 140s, so let's go back through it. Here we got 340s. Here we got nothing. And we got here 420. Again, maximum number of market cap use is going to deliver for you in this business. So that's it for me, folks. Thanks for attending. I hope you enjoyed it. It's a different story here this time around, and I think you've got a lot of lessons that you can apply. Here's where you can get a hold of these slides, 866-794-6065. Or send us an email at strategycall@zackspro.com, or find us on the web at www.zackspro.com. We also have a LinkedIn page, Zacks Professional Services, and a Twitter at ZATools. Of course, your best bet is calling us, 866-794-6065, or using the web at www.zackspro.com, or sending us an email, obviously the simplest, strategycall@zackspro.com.